This is Macro Voices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Macro Voices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Macro Voices episode 87 was recorded on November 2nd, 2017. I'm Eric Townsend. My feature interview guest this week is Grant Williams, a man who needs little introduction since his Things That Make You Go, newsletter is one of the most popular in the business. Grant and I will discuss everything from the U.S. dollar to the Petroyuan crude oil contract to inflation to gold to cryptocurrencies to China and Europe. Be sure to stay tuned after the feature interview for our post-game segment, in which Patrick and I will continue last week's discussion about the knock-on effects of the short VIX trade, as well as a discussion about cryptocurrencies and a whole bunch more.
And I'm Patrick Ceresna. Now, Eric, the S&P 500 has just been chopping back and forth, giving a little on an intraday basis, all these fake outs a little bit higher and lower. It seems to at least found some temporary overhead resistance. But I found it really interesting when they were showing the reports that October now has been one of the least volatile months in history. And even though the market's been sort of treading higher, there's just really been no big swings in the market. How long does this last? Where do you think it's going here?
Well, it comes as no surprise to me that October is one of the least volatile months in history because everybody predicted the opposite. So many people said this October, that's it, it's all going to come crashing down. Markets don't crash when everybody's predicting them to crash. Now, I suppose it's possible that October will come in November this year, but I doubt it because I think what's more likely, as I've described before, is now the bulls come in. You'll see on the cable networks that the recordings are being played of the people who said watch out for October, talking about all of the risk in the market. They'll be ridiculed and there'll be a little bull party and everybody will celebrate and go even more long the market. I wouldn't be surprised if we see a melt up from here to the end of the year. At some point, this is going to end badly, but the signs that you see before a blow off top, we haven't seen yet. You usually see a parabolic rise where momentum really just goes crazy to the upside before the final top is in. We haven't seen anything like that. We've seen a steady grind higher. I did also think a little bit more when we talked last week in our post-game segment about how the short VIX trade might be contributing in some way to the stock market. And you told me, and I think at the same time, we also got some feedback from Harley Bassman that my first theory about that probably didn't make a lot of sense. I got a new one for you, but we'll save that for the post-game segment when we have more time.
All right, well, let's move on to that U.S. dollar index, which doesn't seem to be giving up any of its gains from earlier in the week. And obviously, I was thinking that this whole new Fed chairman and all of the Fed news would have actually potentially triggered a new move, either higher or lower. And rather, it seems to be, at least initially, very stable on the first wave of news. What's your thinking on the dollar here?
Well, so far, and I emphasize so far, all indications are, we've broken above that head and shoulders neckline. We've seen what appears to be the Raoul Paul scenario playing out, where the dollar index had a mid-cycle correction down 10% or whatever it was, and now it's going to resume and continue on to new highs. But the thing is, if you wanted to make that argument on a technical basis, I would say that a breakout above the 61.8% retrace level would probably be the convincing thing. That's around 97.50 someplace. So we're not there yet as far as confirmation that the bull move is on, but so far it looks to me like that's the direction. But there's a big caveat here, Patrick, which is, although we haven't heard the official nomination yet, it sounds like Powell is pretty much the choice from Trump for Fed chair. That means the market is discounting their expectations about what kind of Fed chair Powell would be. We haven't been through the confirmation process yet. We don't know how that's going to go. So you've always got the potential of an upset where the nominated Fed chair can't get through Congress or something. There's plenty of room for this dollar trend to change direction as uncertainty about who's really going to be the next Fed chair works through the system. Right now, it seems like there's a pretty good indication that Powell is the man, but hey, anything can change, and that announcement isn't even official yet.
All right, well, let's move on to crude oil, where we find ourselves literally trading at the 52-week highs on crude oil, up just approaching $55 on the upside. Now, a lot of my targets were up here, and it seems like this is a place where there could be an overhead resistance. But, what's your feeling here? Does this blow through the top, or are we so overbought that it's about time here that we see a little bit of a correction?
Well, that definitely is the question, and what I would add to what you said is I really think we're at a very important crossroads here in the crude oil market. $60 on Brent is kind of the psychological number that's in a lot of people's heads. From a technical analysis standpoint, 60 isn't really a meaningful number, but 61 is. Actually, the number is 60.95. That's the 38% retrace of the really big move down from 115 to 27 from the middle of 2014 to the beginning of 2016. So as you know, Patrick, that's a really key level that if we were going to rally up and kind of get to this cyclical high and then roll over and move substantially lower in what, seasonally speaking, it's time for a seasonal sell-off, then this is probably the level it should happen from. On the other hand, if the bulls are right and we really are seeing a structural change from just a rebalancing of the market to an actual tightening of the market, which certainly the backwardation that's developing in the term structure seems to be indicating, well, then maybe this is the major breakout moment where we're going to break above that key 38.2, and that suggests probably 50% retrace is the next target to the upside in the really big picture of things. As you know, the fact that we broke out above 60.95 for a few hours is meaningless. When you're talking about a key level like that 38.2% fib retrace, that's on a move that took 2 years to play out. You've got to stay above $61 for, a couple of weeks before you could confirm any breakout had occurred. If we get that, then I think it kind of points to higher prices. That's at odds very much. I still have a bearish outlook, but frankly, our regular listeners have heard me say that quite a few times, and I've been proven wrong quite a few times. We're at a point now where we've really hit a very, very high speculative long interest. Commercial short interest is at its highs. From a sentiment contrarian indicator standpoint, it's time for this thing to roll over, and there could be a very substantial sell-off. That's my favored case, but I do want to admit here that it is possible if we break above $61 Brent and stay there for a couple of weeks that we could have a whole new ballgame here. So I'm waiting to see what happens with respect to the big picture. Let's just touch on inventory before we move on. Crude oil drawing down 2.4 million barrels this week. That normally would be bullish, but it was not nearly as bullish as the API prediction, which was almost twice as big. That's the reason on Tuesday afternoon after API came out, we saw that big push up to that key 50 spot 22. I think 50 spot 24 was the technical target there, so we pretty much hit it. Cushing, Oklahoma, building 90,000 barrels. Gasoline drawing down 4 million barrels. Distillates drawing down 320,000 barrels. So we're still looking at a situation where from data standpoint, it's no surprise that we saw this roll off here. I think the big question, there was a trend line there at 50.24. There were a lot of reasons to think that could be the high. I'm leaning towards that case, but if we break significantly above this one, it's really time to think about much higher targets being possible.
All right, let's move on to gold now. Eric, we had Jeffrey Christian on the show, and he more or less was talking about the 1260 being his bottom end of the range. And while we haven't really seen anything bullish on gold on the upside, we're starting to see, at least temporarily, that gold seems to be finding its lows along the bottom of the range. Now, I might be speaking too soon, and the U.S. dollar pops tomorrow, and suddenly gold breaks a key support line and off to the races it goes. But at least for now, it seems like it's holding that support. What's your feeling here on gold? Where do you think it's going?
I'm looking forward to asking Grant Williams about this in the feature interview because he's really a big gold guy. But the way I feel about it, Patrick, the scenario that Raoul Paul described, program here several months ago, where gold and the U.S. dollar might both go up at the same time, which is very different from their usual inverse correlation, we really haven't seen much evidence of that. So I don't see that story in play. Therefore, if the U.S. dollar rally is going to continue, I think it's a pretty serious headwind for gold. gold. As I said earlier, the jury's still out on the U.S. dollar. I'm waiting to see what happens with the Fed chair and so forth. But I very much am of the opinion, as I always have been, that in the end game, the dollar is toast and gold is the place to be. It's going to be the big trade that wins all the money. Thing is, I don't think we're at the end game yet. I'm going to ask Grant Williams what his view is when we get into the feature interview.
All right. And finally, I just wanted to ask you about the interest rates. And obviously, 10-year yields had a very sharp reversal. We last week talked about this big breakout above this 240 level. And it didn't take long as soon as we finished our show for us to already see the reversal coming down to about this 234 level where we're trading. But what I find particularly interesting while we're talking about these levels, though, is that we've had a whole bunch of people on all over the internet talking about the steepening of the curve, and that this is now a great place to play the steepener. But yet we look at the 2s and 10s, 2s and 30s all across the curve, and we see nothing but flattening on the curve. And, you know, like you think if the economy was so strong, if GDP was really going to be as good as it is, you would think that we would have actually started to see some steepening, and we're not. Anyway, what's your thinking here on where yields are heading?
Well, I do think that in a time period where we're waiting to find out who the next Fed chair is going to be, that it probably leads to a lot of speculation among institutional traders with regard to the direction of rates and yield curves as well. So as far as all these key spreads like the 2s, 10s that normally would be a very good indicator of economic strength or weakness, I think it's as likely in this environment to just be an indication of what somebody somewhere thinks is going to be the decision that President Trump makes about who should be the next Fed chair. So I kind of don't read that much meaning into rates right now. We're in the middle of this range, 212 at the bottom side, 264 at the top. We're right in the middle, and I think the market's waiting to find out in the middle of the range what the Fed policy is going to be, who's going to be in charge. And I think that's where we'll see a trend start to establish.
All right. Well, thanks for the summary, Eric. Now, for this week's feature interview, we welcome back Grant Williams to the show. Eric's interview with Grant is coming up as Macro Voices continues right here at macrovoices.com.
And now, with this week's special guest, here's hedge fund manager Eric Townsend.
Joining me next is the one and only Grant Williams, the author, of course, of Things That Make You Go, probably one of the most interesting and well-known newsletters in the business. Grant, thanks so much for joining us again. I want to start, as we always do, with the U.S. dollar, because everything else is priced in that. I know your partner, Raul Paul, has been a secular dollar bull, but I think last time we talked to you, you had a different view. What's your current outlook for the U.S. dollar? It seems like, maybe we're seeing the Raul scenario play out, where the secular bull market is going to continue. Certainly the chart's been looking pretty good for the last couple of weeks. What do you think?
Hey, Eric. Great to speak to you again. Yeah, Raul and I have differed in the last sort of, year or so about this. We were very much aligned. And then I I went to the dark side and figured that the dollar had run its course and became not a bear as such, but I figured we'd seen the highs and the likely future path was down, not any kind of crash, but it was going to move lower over time. And I based that on the fact that A, it was in everybody's interest. I mean, everybody's interest for it to work lower. And B, I figured that the US finances would actually start to matter at some point. That last point certainly doesn't seem to be the case. But, in the last few months, there certainly have been signs that perhaps the bull market is going to take one more try going higher. The Fed seem determined to hike. And, as always happens, I think the vast majority of recessions post-1980 have been, post the US Civil War, according to a chart I saw recently, have all occurred due to one interest hike too many. So I understand that in the short term, the dollar could go higher, and I can see how that could happen. But I still think that over time, the dollar is going to move lower, perhaps significantly so, but I don't expect any kind of crash anytime soon.
Yeah, I wouldn't expect to crash either. I'm curious, though, because I know that you have interviewed both Luke Groman and Mark Yusko, who both have a view of the dollar that's not a crash, but it is an infinite decline. They kind of think that the party is over and the U.S. dollar is going to fade into the sunset and be replaced as the world's reserve currency. Personally, I'm convinced that they will be proven right in the end game. I'm not so convinced the end game is upon us yet, at least that end game. Do you think that this could really be it for the dollar in the sense of the decline that you see leading to dollar losing its hegemony in the global finance system? Or are you just looking at a secular, but not quite the doom and gloom of Luke and Mark?
I think you articulated it perfectly there, Eric. I think they're both right, but I think you're right in that you don't think that's happening just yet. It's going to be a creeping process. The only thing that kind of concerns me about that process, because if you're paying attention, as Luke does better than perhaps anybody, the moves are being made to install the yuan as a viable competitor at first to the petrodollar. That's clearly happening. And I think that is the way this will go, because ultimately when you have the biggest buyer of oil in China and the biggest exporter of oil in Saudi talking about bypassing the dollar, that's a big deal. But I think many people aren't really paying attention to that story because it's a little out in the weeds. I think that is the natural place this is going. But I think, to your point, we're probably not going to see the acceleration phase for a little while yet. And between now and that acceleration phase, I could perfectly understand and see how another rally in the dollar could play out.
As long as you touched on that Petroyuan story, let's stay there for a minute, because I'm really curious to get your view on this. I know you've looked at this carefully, as I have. It seems to me that if the Petroyuan oil contract on the Shanghai Futures Exchange were to gain traction, and a year from now we're talking about how the Brent contract lost 35% of its market share to the new yuan-denominated contract. Okay, that would be game on, and it would be probably the biggest news of our lifetimes. I'm thinking it's not going to happen. I think that it's symbolic. I think it's important, but I think it's going to be a sideshow. I think everybody's going to say, yeah, okay, well, the world still does business on the Brent contract. Do you think it's going to get traction? Do you think that it's really going someplace, or do you think that it's really in the propaganda and marketing space for now?
Well, to me, having it in place is the crucial change. And I think whether it's symbolic initially, the trouble was always going to be creating a viable alternative to the petrodollar. And essentially, once they open these, that's what they've done. And it's there. So the escape valve is there. And if nothing else, it puts pressure on the US in terms of what Luke calls very nicely the weaponization of the US dollar. It lessens the ability that the US has to bully people with the dollar, because at some point there is a parachute there that's up and ready to go. And frankly, if the Chinese just decide, okay, fine, we are just going to transact with the Saudis and the Russians through this mechanism, that would be enough. So I think there will be a hell of a lot of stuff going on behind the scenes, a lot of discussions and negotiations, but I don't think immediately this thing is going to become the market for oil. That's too big a stretch. But I think it very subtly but very meaningfully shifts the balance of power, which has been exclusively with the US and this ability to weaponize the dollar. And it does give some of the smaller kids in the playground the means to potentially stand up to them. And I think that's the shift. A lot of people talk about this whole gold, yuan, oil triangle, and they get confused between a gold-backed yuan and just this ability to pay for oil in yuan and to convert that into gold. And I think the two things are separate. And what we're talking about here in terms of giving the Chinese the ability to print yuan to buy oil is a very meaningful move that the full force of which may not become apparent immediately. But I think it changes the game materially.
Jeff Christian made the argument on this one where he said, look, there is no gold-backed anything. You've got a contract which is payable in yuan, and you have the option to spend those yuan. There is no guaranteed conversion rate or anything. If you want to spend the yuan to buy gold at the market price, you can do that. You could spend it on dim sum, for that matter. There's really nothing that guarantees any convertibility. So Jeff thinks that it's pure marketing. Do you think there's anything more to it, or is it really just as simple as this is a yuan-backed contract, and the comments about gold-backed are really just a marketing statement saying if you wanted to convert that yuan into gold, you could do so on the open market?
Jeff's right, but I think that's missing the point. It's not a gold-backed contract, but the issue has always been being able to get your Chinese currency out of the country. So to make it convertible, even if there's an extra leg to it, makes all the sense in the world. And I think it's a big deal. I think it's a big deal that you can transact the world's most fluid commodity between the largest buyer and the seller in a currency that's not the dollar, but you have an escape valve. and you can actually get physical gold through the exchange in Shanghai. And I think it's a meaningful change. I think it's a very meaningful change to the status quo. And, Luke Grumman, had a fantastic interview with Luke. He's, to me, the guy that's done the best work on this. And if you read through the way he posits the story, to me, it makes an awful lot of sense. And I think it's important for the Chinese to set this up, which they've done. I think it's important for them to kind of feel their way into it and work out what leverage it gives them. But as I said, I go back to my earlier point, what this is, in effect, is a very clear escape valve should the dollar be used to try and strong-arm the Chinese into actions that they're not particularly keen on doing for their own self-interest.
Well, I guess it certainly does. It eliminates the possibility of U.S. sanctioning China and preventing them from being able to buy oil, and that certainly is very important. Let's move on to the stock market, because you guys at Real Vision have produced a fantastic video called Edge of the Cliff, basically saying what you and I and Jesse Felder and a lot of other people have been saying for years now, literally, which is that these valuations just don't make sense. You look at the CAPE ratio, you look at dozens of other things, it seems like the stock market is crazy high. But, that's old news. But the question I've come to ask is not, are valuations high? I think we all see that. But if you look at what's happened and how the market has just continued to march higher, what's going to change it? What's going to be the trigger that suddenly throws a monkey wrench into the works and things fall apart?
Well, that's the $64,000 question. I think that's what we're all trying to figure out. The process of making that video was actually very interesting because we just noticed this rising tide. Rail called them drumbeats of guest after guest coming on and expounding very similar theories about valuations, about the speed at which the market was reaching a point where something is going to tip it over. Now, the problem is there are so many potential tripping points that it's almost impossible to pick which one it's going to be. And it's most likely going to be something that really nobody's thinking about. Is it a correction in Australian housing markets? Is it a correction in New Zealand housing markets? Auckland's just seen the first fall in property prices for 6 years. Is it something out there in the boondocks? Is it the resumption of the dollar bull market? We really don't know. But the longer this goes on and the more one-sided the boat gets, the more dangerous the snapback becomes. And so we put that video together just to say, hey, look, markets are going higher every day. It's the most passive bull market I've ever seen. But that's the time you don't necessarily need to panic, but you really do need to take the time to think about, okay, what's happening here? Why are my monthly statements so great? Do I just want to sit back and watch this happen, or do I want to understand this and at least go through the exercise of thinking things through and deciding for myself, am I happy still being fully invested here, or should I take some money off the table? Because the worry for me is that we don't get a gentle correction of these markets. In trying to sort of game this and try and figure out what might happen and what any kind of snapback might look like, I try and put myself in the position of the Federal Reserve, who have been the anchor for what we've seen from 2009. And with Yellen talking about hikes and the Fed being clearly intent on pushing rates as high as they can, I would posit because they need some ammunition the next time we get a recession. But there's a very clear chance here that they may, if the market falls 5%, let's say, for example, that they may step back and say, you know what, 5% from these levels, that's great. That lets a little bit of air out the bubble. And perhaps we should just let that happen and tell people that, unlike January or February of 2016, we're not going to ride to the rescue when the market comes a little unhinged. Now, with what they've done in terms of instilling that belief in market participants that the Federal Reserve are there and we've got your back, by taking that action and trying to let a little bit of air out the bubble, down 5% when everybody turns to the Mariner Eccles building and waits for the sound of hooves as the cavalry ride over the hill. If that cavalry don't come, and more importantly, they send out a messenger who says, you know what, we're not coming. Don't worry, it's going to be okay, but we're not coming this time. We're just going to let the market settle a little. I think at that moment, everybody has to then reprice every asset that they own based on the fact that there is no Fed backstop. And if you do that and you reprice everything ex the Federal Reserve's intervention, I can't think of a single asset in the world whose price would be higher than where it is now. And that incredible correlation we've seen where everything seems to have a correlation of 1 to everything else, could really reinforce itself. And you might get from that 5% fall, you might get a very quick 15 to 20% fall. And that to me is a very plausible, I don't want to say it's probable, but it's a very plausible path for this market to take. And I just worry that when things do turn, when we get a market that falls, I just don't know who the buyers are. We've had the dip buyers, that's fine. But with so many people having lifetime high exposure to equities who are approaching retirement, we've spoken about this before in terms of the boomers having huge allocations to equities because they can't get the income on their bond portfolios. These people can't afford to take a 15 to 20% drawdown. They don't have the time to make that back again. And so I worry that if markets show weakness, the Fed try to do the right thing in letting it fall a little bit and take some air out of the market, that things could snowball very, very quickly. And at that point, the Fed may then have to step back in. And then we finally get to that stage where their credibility is clearly impaired. And that's the point that a lot of people, guys like Bill Fleckenstein, have been waiting for the loss of credibility of the Federal Reserve and other central banks. So you can see ways where this could get out of hand very quickly. And to me, it's not a case of saying this is what's going to happen tomorrow. It's a case of saying, okay, at all-time highs on just about every asset class on the planet, I need to sit down and I need to think about why I'm invested, where I'm invested. Am I happy with my exposure? Do I want to raise some cash and just be cautious? Because to me, you have to have a plan for what happens when the market goes the other way, because it will. I mean, markets don't go up in a straight line forever. There's going to come a point where markets go down, and I think we're closer to that every day. And I just think people should have a plan as to how to deal with it.
Grant, another subject you mentioned, we're all talking about beating drums and the changing tone of guests. I've noticed something, and I'm sure you probably have too. Just 6 months ago, every single guest we interviewed said, forget about inflation. It's all about deflation. Now we're seeing a real turnaround. More and more guests are really talking about a resurgence of inflation. Hugh Hendry has told both you and I his view about it's being 1965 all over again. Do you think it's time for inflation? Where are we in the story?
I think that now is a very distinct possibility, certainly more so than it's been in the last few years. I don't think we're quite there. You can't really see the whites of inflation's eyes just yet, but it's interesting that the pressures are certainly building, and that could be another one of these moments that tips this whole thing over the edge. If we really do get clear inflation in the Eurozone and in the US, particularly with wages, that I think is the key. If we start to see wage pressure, which has been strangely absent given the low unemployment rate, that would be the canary in the coal mine. And I think if we do get that return of inflationary, again, it's just another one of those really clear paths to markets changing their character. And I think it's that changing character that is the real danger. Markets have been so docile for such a long time now that volatility is down where it's down single figures and seems rooted there. But once that changes, once the character of the market changes and we start to see a different set of variables, if we are seeing increasing inflation, that's going to change an awful lot of things. And the dominoes from the inflation story picking up go to all sorts of places in the market. And suddenly the character of the market changes. And once the character changes, responses change. And once responses change, a lot of the computer programs will change. And so, as I said, this correlation of everything is very, very dangerous given the sort of perilous state of where we stand now. The US GDP at 3%, 1.2% of that was inventories, which are already at all-time highs. So the growth, I don't think, is there, and certainly not to the degree that I think the Atlanta Fed came out today, and they're expecting 4.5% for the next quarter, which the history of the Atlanta Fed has been to start with a high print and then walk its way ever lower down to somewhere in the high ones most times. But again, they're out talking about 4.5% GDP prints. I don't think we're going to see that, but I do think we have a very clear way where we could see inflation pressures. As I said, that will change the character of the market.
We should mention, too, for our listeners' sake, that we are recording on Wednesday, and we do not know who President Trump's nominee for Fed chair is going to be. Our listeners probably will have heard that news by the time this episode airs on Thursday evening. Let's follow the inflation, though. As you said, it leads to lots of other markets. I know one of your favorites is gold. And I guess my question, I know you're a big fan of gold. So far, at least, it seems like the dollar is recovering, and that presents a headwind for gold. So is it not gold's time yet, or do you think that gold and dollar both appreciating at the same time scenario that we've talked about for the last year or two is eventually going to come about?
Yeah, gold has been remarkably quiet. When you talk about me being a big fan of gold, to me, it has a place in, I think, everybody's portfolio right now. I fully expect there to be a time when that allocation would be minimal. But right now, with what's happening, the fact that gold isn't moving, to me, it's just a great opportunity if you want to own gold. Now, there's a big difference between people that want to own gold as portfolio protection and people who want to trade it. And I totally understand the two. And there are a lot of people who look at charts and think, well, gold could go down to $1,000. And could I see that happening? Absolutely, I could. I think Harry Dent's call of 700 is a little far-fetched for me. But if gold goes down to $1,000, if you want to allocate some of your portfolio to some kind of insurance policy, that is going to be a phenomenal opportunity. Because I think over time, given what's happening, given the stuff that you've covered so brilliantly on your show in terms of demographics, Mark used those killer Ds. We can all see the really, really big picture here. We can see that the entitlements are never going to be able to get paid back. We can see that the answer to that is going to be further money printing by central banks. They're hoping that they get enough growth in the interim to make that go away. But realistically, it's I'm not going to say it won't happen, but to me, it's a minuscule possibility. And so the long-term picture to me is pretty much set. And if I'm right about that long-term picture, then people will want to own some gold. And so accumulating it and not necessarily stressing over the price just makes sense to me. If you're a trader here, would you sell it or buy it? I don't know. Arguably, you might sell it. If you're looking at what's happening in the dollar, you might think, okay, I could get a quick $100 down here. But that's not how I look at gold. It's not a trade to me. It's an allocation, and that allocation shifts up and down depending on the circumstances. Right now, to me, the allocation to gold, particularly given what we've already spoken about in terms of escape plans and taking money off the table and trying to take a pause and see if the markets can consolidate up here and give you a reason for another leg higher. Gold, to me, at these levels is a great place to allocate some of your portfolio for all those reasons.
Now, the crypto guys would say, Grant, as much as gold was not a barbarous relic when that phrase was coined decades ago, look, crypto is the way. Forget about gold. It's just shiny yellow metal. It cannot be transacted instantaneously, globally, securely the way Bitcoin can. Forget about gold. It's all about Bitcoin. So I know you've done a fantastic objective job as a journalist on Adventures in Finance in not taking too many sides, as you've interviewed people on both sides of that argument. I want to know your view. Are we talking about tulip bulbs, or are we talking about the way of the future when it comes to things like Bitcoin?
Yeah, you had to do it, Eric, didn't you? You had to do it. You had to get me out there and make me say something that's going to upset 50% of the world's population. Look, the Bitcoin thing is fascinating to me, and I think there are two answers to that question. I think when you talk about, is it tulip bulbs? Yes, absolutely, it's tulip bulbs. But I'm talking about the price right now. The price of Bitcoin right now, I think, is tulip bulb territory. Blockchain and the future of this technology, on the other hand, I think is one of the most important things that we've seen in our lifetimes. And the thing I've been waiting for with Bitcoin, and the thing that for the longest time now I've said that I want to see before I really understand where it is in its evolution, I need it to be tested. I need to see what happens to Bitcoin when markets fall. If we have a 10% correction, if we have some significant pressure put on markets, I want to know, does Bitcoin fall? Because as we saw in 2008, one of the things that got hit the hardest immediately was gold, because that was collateral, that was margin calls for people. They liquidated their gold to make margin calls. You've got people sitting on thousands of percent of gains in Bitcoin that they're not going to want to give back. So if things get squirrely, one or two things is going to happen. Either Bitcoin is going to get pounded because people think, I don't want to give up these massive gains. Everybody tries to sell their Bitcoin. The processing can't handle it fast enough. The markets freeze up, which kind of feeds on itself. And so you get a big fall in Bitcoin. The other thing that might happen is the markets get really wobbly and people dive into Bitcoin because they see that as some sort of escape valve. Now, either way, to me, both of those are a buying opportunity. If the price gets cut in half because people are panicking, I would be a buyer of Bitcoin. And if it can survive that test, if it can survive those outside pressures, it can survive panic in the broader financial markets and people run to it, then that to me says, okay, well, this price that right now I believe to be some kind of tulip-like bubble, I'm wrong. You know, if people will flock to buy this asset at $6,000 in a panic, again, that would be something that would encourage me to buy it rather than sell it. So I think it's got ahead of itself. I think blockchain technology is the future. As someone said to me, it's triple entry bookkeeping. Once you've got that, you don't go backwards. But we're still very, very early in the piece. And the thing that I find saddest is just this, I guess it's a sign of the polarization of the society we live in, but you either love Bitcoin or you hate Bitcoin. And if you love it, then the haters hate you. And if you hate it, then the lovers hate you. And there's just no dialogue. I try to talk to people about this and try and talk to people who know an awful lot more about it than me. And I'm always fascinated to sit and talk to Bitcoin guys. You know, the podcast you talked about, we spoke to Trace Mayer, who's a good friend of mine, and Bruce Kleinman, and these guys know a lot more about it than me. And it was fascinating to get their take on this, because the simple truth is they all know a lot more about it than me. So while I have an opinion, it's based on the research I've done and the reading I've done and the understanding I've gained. But I would never hold that up as some kind of level which it isn't. And so for me, it's just a question of watching the price action and trying to understand the psychology around it. And when I game it out, that's what I want to see. I want to see how Bitcoin reacts to the Dow down 5% in a day, or the S&P down 3%, or the dollar making a big move and volatility returning. Because I suspect the first move will be liquidation of Bitcoin, and I would welcome that as a chance to get in.
Now, I'm curious, when you say that, I thought that interview was fascinating with Trace Mayer. I thought that his own argument to me was the best counter-argument to his own argument, which is he said that Bitcoin just does such a fantastically good job of being government-proof and not being traceable and trackable and seizable and so forth. And to me, that's just cementing in my mind that it'll eventually be outlawed. So when you say that if it were to succeed in a crisis, you would buy Bitcoin knowing that, I think that blockchain-based secure digital currency is definitely the way of the future. But I think governments are going to insist on something that allows them to have all of their controls and all the things that the Bitcoin guys don't want them to have. Do you see that as less of a risk than I do? And if so, why?
I definitely think it's a risk. And as you say, Trace addressed that in the podcast, but unfortunately we didn't have that was a very long conversation that we just didn't have time for. My contention has been that if you make Bitcoin illegal, you basically vaporize 98% of the demand for it, because most people are law-abiding citizens and they won't touch it. But I suspect in a dislocation, people, regulators, officials will have a lot bigger things to worry about than the Bitcoin price at that particular point in time. I fully expect at some point this thing to come under government control. And my friend Simon Mikhailovich makes a great point about the tax implications of Bitcoin. Every Bitcoin transaction, technically speaking, should be taxable. How does all that work? But I think it's still such a new technology, and I'm sure just as you and I are trying to get our heads around it, and everybody else in the investment world is trying to get their heads around it, I'm sure the governments and the IRS and these guys are doing likewise. Now, at some point, I suspect they will move towards doing something to capture this, but I don't think that's going to be out of the clear blue sky overnight. Trial balloons will be floated, papers will be written, all kinds of things will be posited. So I could be wrong, but I just don't think this is something that is going to be knocked over overnight. I just don't see it. It's so complex, and it's so misunderstood, even by the people who are building this thing. It's evolving and changing every day, and we all know how slow governments and officials are at sort of getting their hands around these things. So I'd like to think that you still have a reasonable amount of time before that becomes the biggest thing you have to worry about.
Let's move on to Jeff Gundlach's infamous call that nobody believed at the time, but he's been right so far, when he called to the day what he said was the end of the bond bull market last year, expecting rates to only go up from there. At that point, I think it was a 1.34 print on the 10-year yield. Raul Paul has been one of the most outspoken to disagree and say that we're headed for 50 basis points. What's your view?
It's funny. I was actually interviewing Jeff, I think, literally the day after he made that call, and I remember saying to him at the time, I said, "Look, you may well be right." I was thinking about this the other day. If you are a portfolio manager, to have managed money in a rising interest rate environment, and I don't mean a couple of hikes here and there, but a secular trend of rising interest rates, you have to be in your 60s. If you're not in your 60s, you haven't managed money in that kind of environment. So if Jeff's right, we're all walking blind here. There aren't that many 60-year-old fund managers around anymore. The ones that made it that far have probably retired, and a lot of them have probably lost active funds to passive funds. So we're all walking blind. Raul's point, I think, is valid in that I suspect there will be one more panic into government debt, but next time it won't be get me sovereign debt, it's going to be get me US Treasuries. I think people won't want to buy Irish debt and Spanish sovereign debt. They will want US Treasuries. Just if this event that we've spoken about during this call, the 5% fall or maybe the 10% fall, whatever it may be, if we get that event, as I feel is possible, then I think there will be one more panic into US Treasuries. I don't think it's any kind of trend. I think it'll be one panic, and then I think we'll start to move higher in terms of yields, and that will be a secular trend. So I don't want to sit on the fence. I kind of agree with both of them. I think in the long term, I think Jeff's right, but I think there could be a 1 or 2 week period where Raul has the upper hand, not to the extent of 50 basis points, unless the dislocation I'm talking about happens and it's major, and people want to buy treasuries at any cost. But I think we could see one more plunge in treasury yields on the back of some kind of market dislocation.
Let's move on to Australian housing, and a lot of people, of course, think Australia's in a property bubble. You live there part of the year at least, so when you're not traveling for Real Vision. What's your view, and particularly a big topic, in the U.S., there was a securitization that I think the unwind or the failings of securitization had as much to do with the 2007 crisis as the valuation of the real estate itself. So is it apples to apples? Is there the same kind of crash risk that exists in Australia, or is it really a different animal?
I just want to check, Eric, because I'm in Melbourne at the moment. I want to make sure that this podcast is going out after I've left Australia, because saying anything negative about the Australian housing market, I'm going to have to lock my door. Look, it's one of the most amazing charts to look at is the chart, and you can find it on the Economist website, the housing index. If you plot the US against Canada, everyone's talking about this bubble in Canadian real estate, and that seems to be pretty widely acknowledged, that the Canadian housing market is some kind of crazy bubble, particularly in places like Toronto and Vancouver. You plot the two of them, you see they go up pretty much in lockstep until 07, 08, and then the US has its correction. We all know all about that. There's a tiny little dip in Canada, and it goes on its merry way again. If you take those two and then you put the Australian index over the top of them, it's extraordinary. I mean, it's not even close to those two, and it's reached levels which Canadians and Americans couldn't even conceptualize. The property market in Australia is a very unique beast, and I was doing some work for my speech I gave down here in Melbourne. Melbourne property prices have increased 1,500% since 1980 in basically a straight line. And that's across all the major cities in Australia. Now, we've had a correction in Perth as the mining boom has kind of slowed down. You've seen some real pressure on the housing market out in Perth. But Sydney and Melbourne have remained remarkably robust. The problem to me, we're seeing, if you look at the bank balance sheets, we're starting to see some pressure on loans at the tails. But Australia hasn't had a recession for 25 years. And when you talk to people in Australia, they firmly believe that housing prices only ever go up, and they've gotten used to the fact that this is a country that just doesn't have recessions. And this is not to say that there's a recession coming. I mean, there is, but who knows? Maybe it's another 25 years. I doubt it, but there's one coming at some point. And the longer this goes on and the higher Australian housing prices get, the more sensitivity there is going to be to even a mild recession. And if people start losing their jobs in Australia, housing prices are at levels that really make them unaffordable. If you don't have a job, you are going to be struggling to pay your mortgage. And so really doesn't take much at the margin here with how sensitive this whole thing is to some kind of downturn for things to cascade very, very quickly. And there's no arguing that the levels, if you look at them versus the rest of the world, are beyond just about anywhere you could think of, with the exception possibly of Hong Kong, possibly Singapore, but Singapore, the housing market's cooled. And we've just, as I said at the start of the show, seen the Kiwi housing market come to a screeching halt. We've seen downward pressure in places like Vancouver, and some of that came from government regulations. But it's clear that the Aussie housing market is a very perilous how little it would take for this thing to fall over. And it's such a cornerstone of society and the wealth of the average Australian that I think it would feed on itself very, very quickly. Jonathan Tepper's done some fantastic work on this. And I have to give a heads up to Pete Wargent, Wargent, who also based in Sydney. He's a property advisory service. He's got some incredible data on this. And if you look through the data and you look at the work that John Tepper and John Hempton have done particularly, you'll see that because it hasn't happened seems to be enough for the average Australian to believe it won't happen. But if you're looking at it from afar, whilst the argument thrown back at you as well, you don't understand because you're not down here in Australia. If you look at it from afar, you can see all the signs that we've seen in every other housing bust, certainly in my lifetime. They're all there. They're all lined up, and they're lined up at a level that is materially higher than any of the others I've seen. And so at some point, this is going to fall over. And given, as I say, what's happening in other parts of the world, I just have that feeling that we are getting close. And it's something I'm watching very, very carefully.
Yeah, we had Pete Wargent on the show a few weeks ago, and I agree with you. He's got some fantastic data. I have to echo just something you said. I think it's so important for people to understand that this is a cultural thing. The last time I was in Melbourne, I should say, I found people were extremely offended, just told you right clearly to your face, do not suggest just because your country had a housing bubble that means we can have one here. And I said, I didn't suggest it because my country did. I suggested it because 47% of your GDP is iron ore exports to a country that's in really serious trouble with a credit expansion that's about to fall apart. And people become indignant. They are very, very offended if you suggest that it's possible for Australian housing to crash. They're in complete denial. And
but isn't that, as I said, isn't that symptomatic of just about everything right now? Whether it's politics, whether it's investment positions, people don't want to hear the other side, which I think is a real shame. For me, if I'm long of a house in Melbourne that's skyrocketed over the last years, I want somebody to come and say to me, you know what? It's heading for trouble. And then I'll sit and ask them why. I want to know why. I want to know, as a Republican, what the Democrats' argument is. I want to know, as a Democrat, what the Republican argument is. But for whatever reason, this polarization of society has become a real problem in that, to your point, people won't listen if you have a different view to them. And when trying to pick the top in markets, when trying to figure out the best time to get into and out of investments, it's so important to challenge your own viewpoint, because we're not all right all the time. And if you're right 55% of the time, you're going to make a very nice living. So to dismiss the opposite side of any kind of stance you've taken, I think is just short term, it's naive, and it's very, very dangerous right now.
Speaking of people taking strong stances, I want to go back to this sport of backing you into a corner and making you take a side on some of the subjects that you've interviewed Kyle Bass, and you've, of course, interviewed Hugh Hendry. Is Kyle ever going to be proven right on this China credit expansion collapse, potential deflationary wave, maybe even another global financial crisis argument that he's been saying it for a couple of years now? Recently on Real Vision, he came out and said, okay, now it's imminent. It's right around the corner. What's your take? You've heard Hugh's side of the story as well.
Yeah, look, as you just said, you just talked about Australia's exposure to a country with a massive credit expansion that is going to fall over. And I think, again, we all know that what's happening in China is unsustainable. This unsustainability is just riddled through every corner of markets. And a lot of that is down to the fact that everything has been done to try and keep the wheels on this thing. So Is Kyle going to be right? Absolutely, he's going to be right. Is it imminent? I mean, look, I don't know, Eric, and I think we all have to admit that we don't know. And China is arguably the place that we don't know the most because it's so opaque. And when you've got a country where 27 companies can be asked by the party to delay their results during the Congress because they were worried that the results were going to be poor, how do you handicap that as an investor, as an outsider who's trying to take a position and make a profit? It's really, really difficult. So I think Kyle is absolutely going to be right. To me, there's no question about it. But this could go on for a very, very long time. And it's to me, is China the first thing that tips over? I doubt it, because of the fact that they can keep doing this stuff for perhaps longer than some of the Western developed democracies can. And look, let's face it, I don't think, talking out of school here in terms of casting doubts about the veracity of some of the Chinese data that comes out. I said this in a presentation 3 years ago. If there ever was a meltdown in China, would we actually know about it? I don't know. So I think it'll happen, pretty sure it'll happen, but I suspect we may find out it's happened after the event. And so to take a big bet against it, I just think is a really difficult thing to do. I think if you see signs that it's starting to crack, you'll have plenty of time to get a trade on. But people say to you, never ever, you can say what, you can say when, but never say both. And I think although you have to try and position yourself along a time horizon, coming out and saying, okay, it's going to happen now or in the next month or the next 3 months, look, we're all guessing. It's the future. None of us really know about the future.
Well, since you mentioned that it might not happen first in China, let's move on to Europe, because last time we had you on the show, you were very outspoken in saying, look, Brexit was the nail in the coffin. It's a matter of time. It'll probably take years to play out, but more countries are going to leave the EU. The EU is doomed. Is that still your view? And how are things playing out compared to your original expectations?
Look, it's absolutely still my view. And I think if you look at what's happening in Spain, the writing's on the wall. I mean, it's very clear what's happening there. And whilst we still don't know how that's going to play out, this is, to me, way more serious than Brexit. The UK, the Brits, we were never really, I don't think at the margin, Brits felt European. We have this cultural identity that's born of being born, born of being born on an island. We just have that mentality. And I don't think the average Brit thinks of themselves as a European. They identify as British first and European second. But Spain is very much in the heart of Europe. And to have what's essentially turning almost into a revolution is to me another nail in the coffin. And the way it's been handled by the EU, I think, has been appalling. Not that there's any easy way for them to handle it, but I think Rajoy overstepped his bounds with the police going in there when they had the ballot. The fact that the separatists haven't backed down, the fact that they are challenging Madrid overtly to try and put pressure on them, tells me that this runs very, very deep. And if you look at what's happened in Austria, we have a 31-year-old leading Austria. Again, a large country in the center of Europe has a 31-year-old premier. And this guy is not a fan of increasing Europeanness, for want of a better word. So this tide is kind of spreading throughout Europe. You look at the youth unemployment rates right across the continent; they're still incredibly high, and there's a disaffection sitting beneath the EU that is too readily glossed over, in my opinion. And when you look at the way the negotiators are dealing with the Brits, with leaks about dinners between Jean-Claude Juncker and Theresa May, the British Prime Minister, pressure being put on in all the press, it's a very underhand and a very devious way of conducting business. And I think that speaks a lot to the character of the European negotiators. This idea of a European superstate is such an important central plank to how they see the world that they really don't have any flexibility. And so they are going to keep pushing. And when we get events like the Catalonian independence movement, they are, instead of going to sit down and listen and try to negotiate and try and work out, okay, what is it exactly that you don't like? What is it that's causing the friction? Let's maybe come up with a compromise. For the European, the EU bureaucrats, there is one way and one way only. That's more Europe. That's more integration. That's a European military. It's just more and bigger Europe. And when Peter Atwater talks about this whole split in social mood and how people are now all about themselves instead of about the broader body, that is translating through into politics. And countries want to be themselves and not part of the wider body. And the wider body is starting to put pressure on them in ways that I just do not think, given the elevated tensions, are going to work in the way they think they would. So I think Europe is doomed as it is. I think it's not finished, but it's doomed in its current form. And the sooner the people in charge of making these negotiations realize that and start being sensible about their solutions to these problems, Catalonia is not going to be the last situation we're going to see. So I'm watching very closely how they handle this, because I suspect this is not the final blow up in this wave of independence seeking across the continent.
Unfortunately, I'm absolutely convinced that you're right, and I just fear how much more. I mean, the business of the police coming in and beating unarmed women in the head until they were bloody at the head for the crime of trying to vote in an election that was sanctioned by the local government, the sitting local government, if not the national government.
Yeah.
Wow, that's just crazy stuff, and I fear that it's only going to get worse. Unfortunately, we are running out of time. Before we close, though, I think, Grant, that your name has become so associated with the Adventures in Finance podcast. A lot of listeners don't even realize that you write what probably is one of the most involved, longest, most interesting paid subscription newsletters in the marketplace, things that make you go, And of course, out of respect for your paying subscribers, we were unable to share the latest edition with our listeners, but we do have a link in your research roundup to a back issue from just a few weeks ago, back on the 10th of October, called Never Say Never Again. Give our listeners a sense of what they can expect to find there and elsewhere, and if they like it, how do they sign up?
Well, it's very kind of it. I mean, that particular piece, I was just looking at some of the declarative statements that people make about things that will never happen and could never happen, and started with this idea of Irving Fisher's permanently high stock plateau 6 days before the 1929 crash, and all the way up to Janet Yellen's "we'll never have another financial crisis in my lifetime." People have this tendency to make absolute statements, which are never a wise thing to do at the best of times. But when you go through the history of these things, you realize just how deeply ingrained they are. And so I just tried to take a look at that and see, I just tried to take a look at those and see where we are in relation to some of these declarative statements, all the way down to the corporate level, where the CEO of American Airlines talking about how his company would never lose money again, and the fact that airlines have basically reached a permanently high profit plateau. And generally speaking, these kind of statements happen right before the people saying them get proved to be very, very wrong. So that's what that piece was all about. But I've covered the Aussie property market. I've covered Tesla. I've covered all kinds of things. I just try and write about things that I find interesting and perhaps a little bit off the beaten track, and try to inject a little humor into them, because if I didn't do that, I'd be banging my head on the desk.
Well, it certainly is one of the most thought-provoking and interesting newsletters out there. I certainly recommend it. Grant, I can't thank you enough for another fantastic interview. It's great to have you back on the show. It's been too long. Patrick Ceresna and I will be back as Macro Voices continues right here at macrovoices.com.
Macro Voices is a listener-driven program. Please email requests for specific future interview guests to requests@macrovoices.com. You can email questions for the program to mailbag@macrovoices.com, and we'll answer them on the air from time to time in our mailbag segment. We also welcome your suggestions for how we can improve the program. Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, what a great interview with Grant. You got him talking about just about every cool thing that we have in the macro space. But the one thing that always resides with me is talking real estate. And because obviously I'm from Toronto, and we have here what I think is a real estate bubble. But, when he talks about the Australian real estate bubble, and, we had Pete Wargin on before talking about how these cycles are all playing out. But it's interesting because, while they're all talking about Australian real estate estate being in this bubble. What's interesting, at least here in Canada, is that we've started to already see the house prices correcting. I mean, the peak house price occurred actually back in March and April. We've already going almost 6 months on corrections within the real estate market, and that doesn't seem to be something a lot of people are talking about. It'll be very interesting to see how it plays out in the next couple of months, especially we can maybe ask Jonathan Tepper and maybe get him back on the show. Nonetheless, what was your take on the interview?
Well, I always enjoy talking to Grant. He's a fantastic interview guest as well as a fantastic podcast host, and I most enjoyed backing him into a corner and making him take sides on these issues like cryptocurrencies, that he's been so smooth on adventures in finance and not expressing a personal view on while he interviews people on both sides. So I'm glad he was such a good sport. Grant, if you want to get even, you'll have to have me on Adventures in Finance, and you can turn the table on me. As far as the interview, though, I thought that probably the most interesting part to me was the petrodollar conversation we had near the beginning. Here's the thing, I've been stuck in this place where I am just so totally convinced that Mark Yusko and Luke Gromen are going to be proven right in the end game. I think the U.S. dollar's days are numbered as the hegemonic currency in the world and the world's reserve currency. And I think that gold is going to be the big winner in the end game. But it's such an intellectual struggle, Patrick, because I just have a really hard time believing that we're at the end game yet. I don't think it's time for Luke and Mark to be proven right yet, and Grant is probably in the same camp. I think they will be proven right in the end. I just don't think it's time yet, and I think Grant actually echoed that same view. Well, this Petroyuan crude oil contract is kind of like a trial balloon. It's going to be so interesting to me to see how much open interest develops in that contract. If we're talking 6 months or a year from now, Patrick, and we're saying, oh boy, yeah, the Brent contract used to be the world standard, but it lost 30 or 40% of its market share to the new Petroyuan contract in the first year. If that were to happen, I think it's profoundly unlikely, first of all. But if it were to happen, that would be the biggest signal in our lifetimes that, hey, the end game is on. Things are changing, and the U.S. dollar is, really in jeopardy. I think that the more likely scenario is it's going to be a sideshow. It's going to be a very important symbolic gesture that kind of sends a message. But I don't think that there's going to be any significant trading volume in that contract. I'll be very, very curious to watch that, and I thought that was one of the most interesting things that Grant pointed out in the interview. Meanwhile, we have a little chart book of a couple of charts that we've prepared for our post-game conversation. Listeners can find the download link for that in your Research Roundup email. Patrick, on the first chart that you've got in here, you're looking at the S&P and NASDAQ comparison going into the 2000 event. What's on your mind here?
Well, one of the things that I try to think about, I debate in my mind just as to how things may play out. And we had like Martin Armstrong and a number of guests on the show that are incredibly bullish on this market, thinking that a big parabolic rise can occur, Dow 40,000. And what I found interesting going back to 2000 was that while we did have a parabolic rise in the NASDAQ, which was driven by the tech stocks, all of these different .com startups that were these IPOs that were getting all of this money flow, and it caused the NASDAQ to basically double from 2,500 to 5,000 in a very short order in that 99 window. But what I thought was interesting to observe was the S&P 500 didn't participate in the NASDAQ blow-off. NASDAQ, as the S&P 500, stayed relatively flat. And I sort of asked the question this time around, when we hear guests talk about this idea that it's the Dow that's going to 40,000, it's the S&P going to 3,000 that's going to happen. Well, I ask a question, what if? What if actually that's not where the bubble really is? Like, what if the S&P and the Dow are going to move higher and continue to do what they are? But what if that blow-off bubble parabolic rise happens in the periphery markets? What if it happens that the real blow off is actually in the cryptocurrencies or in real estate or some other type of a market where there's the real blow off, and then when we have the animal spirit shift, the behavioral thing of, well, the air's been taken out of the balloon, then the whole thing just rolls over from there. And it's just, everyone's always looking for this parabolic rise in the S&P. I'm just asking the question, well, what if it's not there?
Well, I agree on some points and I disagree on others, or maybe there are implied points in my head that you didn't exactly say. If you wanted to say cryptocurrency is the new NASDAQ, I'd have to disagree with that, because although I do think cryptocurrencies are in a tulip bubble like, crazy mania phase, the underlying asset is a bunch of bits on a network that somebody spent a huge amount of money on electricity deducing from prime numbers. So I don't think that can be compared to the NASDAQ bubble, where when it crashed, a lot of the underlying companies were going out of business, laying off workers. It had profound impacts on the economy. I also don't think, even as big and crazy as it's become, that the market capitalization of Bitcoin is anything close to what the NASDAQ was. The part of what you said that I agree strongly with, though, is everybody always looks for the next crash to happen like the last crash, and it's not usually the way it goes. So I agree completely that, the big blow-off could be in other things, in real estate, particularly there in Canada where you are, or in Australia where Grant was for this interview. I think that those real estate markets could be the things that send the next shockwave. So maybe it's not a blow-off on the S&P, but I don't think cryptocurrency really counts. I think cryptocurrency is more of a tulip bulb analogy than a NASDAQ analogy.
Well, I guess that's where we could slightly disagree, because, to me, I think that the one thing that cryptocurrencies represent is the animal spirits, the psychology within this. And what happens is that in this period of easy money gains, everyone it's like being high on drugs. It's like everyone is like easy money. And when you see that easy money there, then it makes you much easier to buy anything and just get in, because you're missing out. And, if we see that momentum taken out, even though it's in this periphery market that isn't directly linked, I wonder whether that's enough of a psychological push to turn the tides and everything.
Yeah, I don't know. I don't think that Bitcoin is big enough to turn the tides and everything. I think that if Bitcoin were to collapse, or even if the scenario that I have favored as what happens is government cryptocurrencies are established that are more like, Big Brother Orwell currencies than Bitcoin, and they outlaw Bitcoin. Most people are not going to break the law in order to keep their Bitcoins. The value of Bitcoin collapses. I don't think that changes anybody's animal spirits. I think it's just a sideshow story. But we can agree to disagree if you like.
Well, absolutely. I mean, we'll look forward to seeing how it plays out. We can kind of always do a post-mortem after the fact, right? Nonetheless, what's on your mind in terms of follow-up on the VIX trades that we were talking about last week?
Well, what I said last week is these people that are selling the VIX hand over fist, they're basically giving away risk. They're selling risk that can be bought cheap. And I was thinking, could it be that institutional investors are using that supply of cheap volatility to basically purchase cheap tail hedges that would allow them to use more leverage in their speculation, and that might be fueling what's driving the market higher. Both you and Harley Bassman pointed out reasons why I was probably on the wrong path with that idea. And you said specifically that as you go out of the money on those puts, the skew is such, which is what tail hedges would look like, the skew is such that all of a sudden you're paying much higher implied vol. So that was definitely an education. I appreciate that. But now that I've had another week to think about it, I thought, wait a minute, there's something much, much simpler here. And I really believe in this trade. This is a public service announcement as far as I'm concerned, Patrick. Here's what's on my mind. Suppose that you were to take my advice, which is if you're in the stock market and you've got full long exposure, sell your stocks, take your risk off the table, and if you want to continue to participate in upside speculation that this S&P 500 might not be done and might have much further to go to the upside, do it by buying at-the-money calls. Has there ever been a time in history when you can get those at-the-money calls cheaper in terms of the cost of that optionality than you can get them right now? And I don't think there ever has been. I think that you're getting that gift at the expense of the target managers of the world that are selling the VIX hand over fist. And it just makes so much sense to me. If you listen to what Grant said about the edge of the cliff and how there's so many risks, and so many people have talked about so many risks, the stock market, we don't know when it's going to happen, but eventually this has to end badly. Why wouldn't somebody who's long the stock market close their long positions and just put a small amount of money into at-the-money calls? You've got a way to make the upside. Normally, it's very expensive to buy that optionality, and it's inefficient. But it's on sale right now. Am I missing something?
No, I could not agree with you more. This is a fabulous idea, and your public service announcement is a great one. Because you know what, to me, the options market is experiencing a very unique mispricing. And right now we're seeing a lot of asymmetry starting to move, in my opinion anyway. I'm just sharing my opinion, but I think that the markets are asymmetrically skewed against investors. I mean, there's that old adage that the market goes up like an escalator but drops like an elevator, and this escalator has been going up for a while. We've now had, 12 months of positive monthly closes on the index. This is the first time going back, was it like 1950s or something? And so we've had this period where we're just going higher and higher. And at some point, the market is going to do what the market always does, right? That's why Jeffrey Gundlach was out there buying put options on the market, because it's inevitable that at some point a market will have a correction. And so what happens is we have this very expensive market that, if nothing changes, will probably still keep going higher. And, next month we'll have this conversation, it'll be higher. And then next month after that, it might even be higher. But at some point, everyone believes that there will be the liquidity to get out when it turns, and that they'll see it coming. But if, you look back, almost every single market event has been a liquidity event where literally there is no bids and the prices drop so rapidly. And so how do you keep protecting the gains you've made, keep participating on the upside, and not get badly hurt for holding on right till the end? And the fact that call options today are as cheap as they are is really something that I think is an amazing opportunity for investors to take advantage of. So now in page 2 of that chart book, what we did was take a snapshot of the call options chains out to December on the S&P 500 index. And so it was taken today on November 2nd, and it's going to the December 14th expiration, 42 days out. And one of the things I highlighted here, that vol skew, and it's not the skew chart itself, it's just showing you the vol path, which you can see that as you go farther out of the money on all of these call options, 2600 and so on, you see that the implied volatilities just keep getting cheaper and cheaper, and it becomes less and less expensive to be buying these options on a relative basis to where they would normally be. And so that idea is great.
Okay, that brings a question to my mind, because you're the options guru here. I have a basic knowledge of options, but as I look at this vol skew chart, what it says to me is the obvious trade for me is get out of the stock market. I'm already out of the stock market. And this, if there's anybody who doesn't believe in this market, it's me. And I'm seriously tempted, just by how cheap the vol is here, to put this trade on, to buy calls to participate in the upside. There's no way I'm going to go long equities. I think the crash risk eventually, I don't know when it's happening, is too high. But to do it shorter term, I like the idea. The thing is, Patrick, where I see this vol skew, as you just described, getting even cheaper out of the money, it makes me wonder. I'm thinking just at the money calls so that I participate in the upside. My downside is limited to the cost of the call. Now, my view of what the market's going to do here, I think of Martin Armstrong is just being so succinct and saying, look, the market is already ridiculously overvalued from any fundamental analysis standpoint, number one. Number two, it could still double from here on hysteria and everything. It's got a long way left to go. I don't think too much, Patrick, about how maybe the market's going to go up another 3% or 6% in the next year, and I want to participate in it. I think one of two things happens. Either we get to a point where everything falls apart and it's dramatically down, or we continue to move up probably at an accelerating pace because we haven't gotten into that parabolic rise yet. So I think it either crashes or it goes up a lot. With that view, is the at-the-money call the best way to play this, or is there a way to take advantage of those even lower vol skews that are further out of the money? I'm not sure I want to be completely out of the money with calls that might not come into the money, but how do I play this?
All right. Well, you know what? I certainly have an idea that I would share. Now, first of all, I would say this. For keeping it a simple trade, and if you just believe that there's some upside to the market still here for it to go, the outright call option, even slightly in the money option, so you're buying more delta, is still a very reasonable proposition. But let me speak to you on the very trade that you're suggesting of the fact that you believe that there could be explosive upside potential on the market. This idea that isn't just that the S&P could go to 2,600, but it might go to 2,700, 2,800 on the upside, and that there's a real potential for big gains on the short term. Now, one of the alternative ways to express that trade in these kind of volatility markets is considering the ratio call spread. And the ratio call spread involves, so the strategy involves selling an at-the-money call. In this case, let's say the S&P, the closest at-the-money call option at the time we're doing the show is 25.75 on the S&P. And so let's say you pick up $29 on selling this call option. What you then do is you use the proceeds of that at a higher strike. Let's say in this case we'll use 2,600, and you'll turn around and you'll buy two call options. In this case, let's say they're trading around $15, and you turn around and buy two of those call options for every one call you sold. Now, what you've done here is you've created a ratio spread where you have twice as many calls as you have short calls, and the real loss point, you've really paid for the calls with the short call. So if the stock market reverses and tanks, you've lost nothing, right? If we see that this is where the market top comes in, then the net credit you've made from the one covers the net debits of the cost of the other two, and there's no real structural loss to you. But at the same time, if it blows through 2,600 on the upside, then you now have twice as many long calls as you have short call, and therefore you are participating all the way to the upside. And so it kind of gives you this idea that if the market reverses and tanks, you lose nothing, but if it has an explosive move to the upside, I'm participating, and your real risk point only is that of a modest rise. So the worst case scenarios come the, let's say, December expiration, that the market is exactly at 2,600, and that's where you could actually have a loss. And so if you have that view of that big upside potential, that ratio call spread is one of the ways you can express it.
I think I may actually put this trade on, Patrick, because I do not believe in the fundamentals of this market. But boy, the momentum is there. And I think the most likely scenario is we go up dramatically before we eventually hit the blow off top and then go down a whole lot. So I'm going to definitely sit down and work through some of these numbers. While we're on the subject of these option strategies, Patrick, I know you're speaking as the keynote speaker at the TMX Options Strategy event in Toronto. And we've gotten flooded with emails from people saying, I can't get to Toronto, but is this going to be recorded? Is there a video? How can I get it? So question number one, please remind our audience when that is for people who can go to Toronto that might like to learn more about these strategies in person from you. Number two, for people who can't attend in person, is there a video or some other way that they can participate?
Well, the TMX Options Education Day is being held on the Saturday of November 4th, so just in a couple of days, depending on when you're listening to this event. There's only a few seats left. I think they have a capacity of something just over 300, and we're already at 290 registrants. So there's a few seats left for anyone that wants to still register on the last minute. Just go to the link that's in the Research Roundup email to do that. But otherwise, the TMX exchange is not actually recording the event. So our apologies to those people that can't make it and wanted a copy of the recording. But I mean, I'll tell you, if we have enough demand and interest from our listeners, we can certainly put together one of these events where I can do that presentation and somehow get it recording on a webinar or something, and where we can share it with our listeners. So for our listeners that are interested in that, make sure you reach out to us and let us know, and if we have enough interest, we'll certainly put something together.
And we should remind our listeners, too, that you are in the business of teaching people about options trading as well as other things, and they can certainly go to bigpicturetrading.com in order to find out about your various course offerings on options as well as other trading subjects. Meanwhile, we are out of time, so we're going to have to wrap it there, folks. Once again, we really appreciate you listening, but we need your help. Please tell your friends and colleagues about Macro Voices. Help us promote the show, but most importantly, register your free account at macrovoices.com. The more registered users we have, the more Patrick is able to negotiate to get the very most interesting people onto the program as featured interview guests. The benefit to you is that you'll receive our free Research Roundup email every week, which never contains any advertising or marketing. It's just a compendium of links to all the free cool stuff that we could find on the internet, including downloads from the handouts from our interview conversations, as well as our post-game, as well as a number of other things. Patrick, tell them what's in this week's Research Roundup.
Well, this week you're going to find the transcript for today's interview with Grant. So I'm sure those of you that really liked what you heard and want to go back and read the actual transcript can go back and review that. As well, you'll find the chart book that Eric and I discussed during the post game. You'll also find the recent issue of Grant's. You'll also find the recent issue that Grant was willing to share with us of that things that make you go, newsletter, in particular the one that was titled Never Say Never Again. You'll also find the link to the Bloomberg article quoting Alliance's Neil Dwayne about the outlook of U.S. stocks to stagnate for the next decade, which I thought was a sobering article that actually gave some really neat insight. So it's all there, plus so many more articles in this week's Research Roundup. So that does it for this week's episode. You'll appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com or tag it with the MVRR hashtag on Twitter, and we'll include it in our weekly distributions. Now, if you have not already, follow our main Twitter account at Macro Voices for all the most recent updates and releases. You can also follow Eric on Twitter at Eric S. Townsend. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.